We are going. Ready? What's up, man?
Hey, what's going on, good people?
Episode 9 is here. What's up, everybody? We are back. Season 1, Episode 9. Brett, talk to the people, man.
What's going on, everybody? It is Brett E., better known as the most positive actor. Checking in with y'all. We want to say konnichiwa, ni hao, hola, and what's up?
I like it. I like it, man. Let's get it, man. Let's get it. What's on the agenda for today?
How are you feeling today?
Man, I'm feeling great, man. I'm super excited about what happened, our last episode, the feedback from the episode, and how we're just building off that momentum, man. Seriously, I am super, super grateful and thankful, man, for the growth and the momentum, for sure.
And I just want to say, I appreciate like your consistency. I appreciate that over the years, that you've been like a sounding board for me to just bounce ideas off of, and someone to talk about finances with. Because like in my family, generally speaking, we didn't talk about finances growing up, and I would always want to talk about like, what about this whole finance area of like building real estate and building stock finances, things like that. And a lot of my family growing up were always talking about like LeBron or, let's watch the finals and such and such. And I was like, that's cool, but like, what about like our finances, like as a family? Like LeBron don't care nothing about our finances.
Oh man, nah, man. Likewise, man. I appreciate you being the sounding board for me as well, man. Everything you said, my way, man. Right back at you. Right back at you, man.
All right. So let me give the recap from the previous episode real quick for the people. So last episode, we were talking about cryptocurrency and NFTs. Cryptocurrency being kind of like a new evolution of currency, and ways that people can get access to it are places like Coinbase and Robinhood. Very similar to how you get access to the stock market through E-Trades, and also Robinhood, and then NFTs being more like the digital trading cards currently in the market. And right now, it's so early that people are still figuring out which NFT or which kind of like player that they are going to bet on being successful in the future, similar to like when there was all these different .com search engines and people were vying for who was going to win out and be like the Google, what Google is today. That's the early stages of NFTs. One thing I just want to, before we move on, I want to let the people know about where I think NFTs have the possibility of going in the future. So right now, the major use case are just digital pictures, digital art. But because NFTs being like one of one and being like on the blockchain where it's extremely hard or nearly impossible, I never want to say impossible, but very hard to fake once something has been put on the blockchain. One of the use cases that I can see NFTs moving towards in the future that would be really, really valuable is like the transfer of property. So when you or I sell one of our properties in the future, it can be the deed of that property can be made into an NFT. And then that way it can't be faked. So that way you won't have like people coming from like way back in the future saying like, no, you don't own this property. Like before it was sold to you, my great grandfather, was supposed to deed it to this family member. And so now people like contest if you have right to the property or not. NFTs will could start solving that problem to where you know exactly who owns it and there's no way to fake it because it's on the blockchain and it's been on the blockchain from years ago. Um, Another quick example of a use case where I see it possibly going, if you look at like high end items that people like to purchase, like really expensive purses or really expensive like Jordans, right? Because they're so expensive, there's a huge market of fakery that's out there. And so you come up with counterfeit Louis Vuitton purses or counterfeit Jordans. NFTs could possibly be a use case of like companies coming out with NFTs that are linked to every bag. So you know your bag is authentic because there's an NFT, or you know your shoes are authentic because there's an NFT on the blockchain proving this shoe is a, you know, number 278 made out of 10,000, for example. So I just wanted to make sure that I explain that part to the people about where the future of NFTs is going. Because right now it's kind of hilarious where NFTs are of people paying $1,000, thousands and thousands of dollars, hundreds of thousands of dollars for NFTs that are just literally cartoon pictures of animals right now.
That's good stuff, man. I like it. It's a good breakdown, man. Now they have a glimpse of what's potentially possible. I'll say it that way. For sure, man.
Yeah, so going into that, before we get started, I wanted to make sure that I say we are not financial advisors. You should do your own research and come up with, you know, your own risk tolerance of what you are willing to kind of like risk in these further and further out areas that we've been explaining. We just want to explain to you the concepts of it. And so you have an idea. And these are just conversations that we're sharing with you all between us that we have every week as we go along the process of our financial knowledge. So it's just this whole series, the whole season is made for taking someone that is a little bit nervous and maybe never even stepped foot into the stock market or into investing in general, making you feel more and more comfortable with each episode so that you're able to dive into the market one step at a time.
I like it, man. That's good.
So speaking of, I'm gonna dish to you or pass to you, Alex. Speaking of kind of like higher levels and higher levels of investing, one of the things that we hear a lot about are like there's money made in every market. Yeah. I remember hearing this phrase of like there's money made in every market. So there's money made in an up market, of course. But then the thing that like blew my mind is that people were talking about there's money made in the down market. Mm-hmm. Like, how are you making money when things are going down? So the topic of options trading, or what we want to talk about this this episode. So just wanted to pass to you, Alex, and kind of explain from your mindset, because I know we both like options. We both use a smaller portion of our portfolio to work with options. But if you could just explain options to the people.
You know, absolutely. So options are definitely an extra tool that you can have like under your belt, right? And so when you think about options in this way, as the market goes up, again, you can make money. As the market goes down, you can make money. Well, how does that happen? It happens due to options. Let's break it down further. So I am naturally a long-term investor. That's my mindset. I'm a long-term investor. So please make note of that first, right? I'm a long-term investor, meaning that the longevity or longer term perspective of investing should be your starting place. Like the get rich quick, get in, get out type mindset has caused people to lose a lot of money. And so a longer term mindset is where it comes from. It's what's needed when it comes to investing, right? And so a thing that was happening to me though was
every swipe of your GTE Financial debit card, you give back. Because your money goes to help local charities like the Boys and Girls Clubs of Tampa Bay. So swipe it forward with GTE.
Again, when the market began to go down, is that my portfolio was losing money, but then I started hearing about other people who were, even though they were also losing money, they were gaining money with the extra tool. And that's when I started hearing more and more about stock options. And so I began to look into it. And so imagine it this way. Imagine you and I were playing a game together, Monopoly, whatever it is, Uno, whatever. And I knew and I knew more about the game than you knew about the game, right? And I kept winning. You would be like, hey, how are you continuing to win? Well, if I have access to additional items of wisdom that you don't, or tools that you don't have, hey, the game almost feels unfair to a degree, right? And so that's what stock options do. Let's get further into it. An option is very, very straightforward. First, it's very, very risky. I'm saying that multiple times here. It's very, very risky, but let me be very straightforward. What an option is a contract, okay, or an agreement. Please write that down. It's a contract or an agreement. When it comes to, I'll just use, for example, Microsoft, for example. If Microsoft was to go, say, from $275 and it moved up $1, it would go up $276, meaning you would make $1, right? Because you have, in this case example, one share. You would make $1. Not too much to get excited about, right? I get it. I understand it. This is where options take the game to a whole other level. Because options, as a contract or an agreement, it allows you to be able to control, not own, control 100 shares of Microsoft. Let's get it. 100 shares of Microsoft. Was that this takes your risk and your reward to a whole different level, right? Now, how do you control those 100 shares of Microsoft in this case? Two separate ways. Well, there are a number of ways. We'll explain two today. One, write this down. One is called a call. One is called a put. A call option or a put option. Okay? A simple way you can remember it is this. When you buy a call, you're expecting the market to go up. When you buy a put or sell a put, you're expecting it to go down, right? So here's how I remember it. When it comes to a call, most times you pick your phone up, right? You're picking up the call, right? So it's coming up. When it comes to a put, most times you are going in a downward movement when you are doing a put. You're putting something down. You're putting down a cup, right? And so a call means that you expect the market to move up. Maybe some news has come out. Maybe earnings have come out. Maybe they've developed a new product, new software idea, etc. And you expect the market to move up. Vice versa, if it's moving down, you would buy what's called a put. Again, either scenario, with any option contract, you're controlling 100 shares. Okay. Now, here's how this further works. Say let's use call, right? Let's start with the call. Say you were going to buy a house, right, in a new development, and the builder comes to you, and the builder says this house is going to cost $200,000, right, to build this new home in this new area. Well, maybe you had insight that they were going to be building new things or new developments, or there was new zoning that was coming that you expect would bring values up. So what you would do is you would enter into an agreement or a contract with the builder that says, I can buy this house at $200,000, right? And so, and I can buy it at this price for the next, let's just say the next year, right? Here's what happens. over the next year, say they start developing around this area, this community, start building new things, and people start coming in. So say when it's time to begin this building project, or it begins to go up, right? Say it's valued at $300,000 8 months in, 9 months in, etc. Here's the power of options. Because you have a contract, a call option, which is a contract or an agreement, that you can buy it at 200,000, even though it's now valued at 300,000, guess what? You get to earn or profit the difference, which is $100,000. Because you now have you had a contract that says, no matter where it goes, I can buy it at $200,000 because of the contract that I have. That's what it magnifies. It magnifies your ability to earn. Now, here on the flip side of that, with the put option, remember, call is up, picking the phone up, put is down. On the put side of it, tie it in this way. Imagine you were going to buy a car this time, right? Here's how a put option works, or a put agreement works. Say this car costs $10,000. No, y'all big ballers, right? Yeah. Say it costs $30,000, right? So the car costs $30,000. Okay, you enter into an agreement because you believe and you know, hey, when I drive this car off the lot or whatever, it's going to do what? Go down in value. So you enter into an agreement with a put option because you believe the value is going to go what? Down. You enter into an agreement that says this, all right? I can control this contract at 30,000, meaning I can sell, big word there, right? I can sell this contract for $30,000 even if the value goes down. So you drive it off the lot and you've had it for a period of time and the value drops down to $25,000. Well, because you have a contract, right, for $30,000, you now profit from the 30,000 minus 25,000, which means you will earn $5,000 because you entered into an agreement that said you can sell this vehicle at 30,000 no matter how far it goes down. If it drops to $20,000, you will make $10,000. If it fell to $15,000, you would make $15,000. 30 minus 15. That's the power of what options present. Again, before I have Brett chime in here, again, I must say this quite a bit. Options are an incredible tool that can be a part of your investment portfolio, but keep in mind they can be very risky because if you think it's going in one direction and it goes the other direction, you can lose severely, right? And so that's how a brief overview of what options look like. Call, picking it up, market's going up. Put, down, market's moving down. So that's a brief intro into the power of options.
That was excellent. That was excellent, Alex. One thing I want to make sure that we bring up at some point that we might not have written down is the premium factor, paying the premium. So to put in a little different perspectives, just so we, try to hit people on both sides of their mind. Think about, so options contracts give us the right, but not the obligation to purchase 100 shares of a given stock during a time window, right? So the option to purchase, not the obligation to purchase. Like if you buy a share, right? Like you are taking on the obligation of the second you hit buy, then you own that share. But they also, like another way to think about it is like options trading are borrowing someone else's shares, 100 shares at a time, borrowing that for a determined period of time. So, and you have to pay a premium to do that. So you pay an additional fee to that person that's letting you borrow those 100 shares and you have to determine the time window that you are borrowing those shares for.
With every swipe of your GTE Financial debit card, you give back. Because your money goes to help local charities like the Boys and Girls Clubs of Tampa Bay. So swipe it forward with GTE.
And for longer time, you pay longer money to hold those shares for that longer time. So like Alex was saying, with calls, you are betting that the stock is going to go up. With puts, you're betting that the stock is going to go down. Excuse me, but you also have to decide the time window that you are going to borrow those shares for. So one thing that we keep in mind that goes along with options contract is called the strike price. So simply put, when Alex was talking about Microsoft, let's say like $2.75 a share is the current price. So you can either pick, let's look at call options first right now. So I think that Microsoft, that's currently trading at $275 a share, I think it's going to go up in the future. So the strike price is what trading price I think it's going to go above in the future. So I could say 275, or I could say 270. I think it's going to get to 276 in the future, right? So 276 would be the strike price that would be on the contract that I'm borrowing 100 shares for. So I think it's going to get to $276 in the future. So that would be the strike price. And then also the expiration date. That's the time window that I am purchasing to be correct in my choice of like the stock going up to 276. So you can do that in like weekly time periods, or you can do it in 2 weeks, a month. You could go all the way out to like a year or more. But the more time that you purchase to be correct in your guess of the stock going up in a call option, the more time that you want to be right, it's going to cost you more along those lines. Alex, anything you want to add to that?
No, absolutely, man. I think that's adds a lot of value there. I'm just gonna give you all this like straight up because I know some of you have heard about it, may have tried it, may have been discouraged after you tried it, possibly, or those who are interested in doing it. I must give you this upfront, and please play this video back 2 months from now, 5 years from now, however long it takes. Listen, please hear me here. If you decide to do options, what homework's coming later. I'm gonna give you this part up front. Only buy options in the money and make sure you have at least a minimum 3 weeks to a month, etc. time period or expiration date, as Brett mentioned, on your contract. The reason why is because, as you already know, you've seen prices move up and down. And when you buy time, give yourself time, it's what allows you to be able to ride the wave. Or if you do slightly get the direction wrong, gives your option the opportunity to rebound in the correct direction. If you're buying like I know that some of you may this may be new to many of you, but if you try it or you attempt this or you have before, you can come in the comments right now and admit this, man. Those weekly options are dangerous. Like you only give yourself a week, right, of time to have a stock move in a certain direction. It can be, while people promote it very often, it can be very dangerous and you can lose a lot of money that way. And so again, just make sure that you're buying in the money. In the money simply means that if, as with the breast example, say something is valued at 275 or 276 as the strike price, you buy it, so it's costing you 270, 278 or 280, meaning on the put side. On the call side, it would be 274, 272, meaning that it's already above that on the call side, right? Which means that I know it's already here already. So if I lose a little bit, it has an opportunity to go back up again. And so you want to buy it in the money, not out of the money. And while that may be new to some of those terms, look them up. Listen, Investopedia is free game. Put it on your bookmarks on your phone, internet, whatever. Investopedia. Look up in the money and out of the money. And I think that's just something else I want to add to that to make sure you all can just hear that. And I know this is a new level or advanced level of investing, but we wanted to present this to you all. So yeah, in the money. Do not buy out of the money options. They're very, very risky.
Just to put a point on what out of the money would be, so to buy something in the money means that you're already buying a winning ticket from the second that you click purchase. Right? Now, to buy something that's already a winner and you think it's going to be more of a winner, it's going to cost you more money. Now, just to give an idea of what out of the money is saying that I think it's going to be so much of a winner that I don't have to buy the winning ticket right now. I can go a little bit out of the area because I think it's going to go up here. So I can buy an option right here, and then it'll cost a little bit less because you're not buying a winning ticket to start off. It's riskier because you have to be super right. So that's why Alex and I are saying, first we're saying, like, don't even start doing this yet. We're just giving you the information so that you understand what it is as you start evolving in your like knowledge arc of investing. But buying out of the money is riskier. It costs you less money, but it's riskier because you have to be super right in order to start making money. Whereas when you buy in the money, you're already correct the second that you click to purchase that options contract for the amount of time window that you need. One thing that I wanted you to touch on, because I know this is like a passion of yours, Alex, just teach the people really quickly about time decay. So I know we were talking about like buying the length of time that you want to be right, whether that be like 2 weeks, 3 weeks, a month, 2 months out, to be correct in our guesses. But teach the people a little bit about time decay and what that means.
Yeah, so imagine this, like when it comes to options, that the value that's built into the option, call or put, time is vitally important, meaning the time that you have remaining for that particular stock to move in the direction that you want it to move in, right? And so the more time you have, the better, right? So when it comes to time decay, listen, the moment you purchase that contract and an hour goes by, 2 hours, next day, etc., it begins to eat away at your contract. Your contract begins to lose value. But if you have more time, it goes slower, right? It's like having a little hole in the water bottle. If it's a weekly option, it's like having a hole like this, and so it's just flowing out like off the jump. So you have to be right real fast. And so
I just thought about an idea also of like, like when you buy something like and you put it in the freezer, that you have a refrigerator, you can lengthen the time of your produce, for example. But a weekly option is like buying an avocado. The avocado, you buy it, and like by the time you get home, you got like 3 hours left before the avocado goes bad.
You gotta move fast. You gotta move fast with that, man. And so like that's, man, I'll tell you, man, adding adding time has been a game changer. As we're all still learning, right? No one has it completely figured out, but it adds incredible value. And one thing that we are highly encouraging for those of you who are even interested, as a really clear like takeaway from all this, right, is that there's something called paper trading or a simulated account, whereas you don't have to put your actual money up, right? You can do what's called paper trading or simulated trading. Most platforms have it, or many platforms have it. TD Ameritrade has it. Um, uh, Webull, if you want to use Webull, Webull has it. There's a various trade station. There are a number of platforms that are available that allow you to be able to do it, and so you can actually use options or even stocks. Maybe you're teaching your kids or what have you. You can use paper trading or simulated accounts to get a feel for it before you actually invest your money. I'm telling you, it's a win-win to be able to practice before you play.
Wait, we talk about practice? We talk about practice. Yes, we are talking about practice. Practice before you play. Another app that I used to use with some friends when I was like teaching their kids how to trade stocks is there's an app called Best Brokers. It's free and it starts you, and it's linked to the actual stock market, and it starts you off with like 10,000 per $10. But then you can actually like decide what stocks to buy with that 10,000, and then you can see how it grows or shrinks over time depending on the ideas that you have in the market. So that's another way to kind of paper trade as well.
That's good, man. That's good.
But any other action steps that as we wrap up this episode, Alex?
I just have to reiterate, options are risky. I cannot say it enough. Like, if you are new, listen, I'm gonna say it. You know, Brett is the most positive actor in the world, right? I'm gonna be the most candid, right? So check this out. They are extremely risky. If you are new to stock market investing, please hear me because I love you. I really do. Do not invest in. You all work so hard for your money. You put time in, all that. You do not want to lose or have your money evaporate. So again, if you're new to stock market investing, take your time. Take your time learning how the market works, how it moves. And then again, paper trading. Paper trading, do that first. Once you really, really feel you have a great grasp, remember the other part of that, and I'll be done here. In the money, 3 weeks, a month, or more time. Replay this video. Replay this video.
Y'all better listen to Alex. Some of y'all ain't gonna get this to the ride home. You need to replay it because options want to eat your money. Now, Alex and I have been diving into this part of the market, you know, so we can gain the knowledge base and bring this to the community, to you all, so you don't have to go through it. But I've definitely taken some hits, trying different options as we are, you know, learning the process. Definitely taking some hits, but it's all part of the learning process. But now, paper trading is a thing that's out there, so you all don't have to risk your actual money for the knowledge.
Absolutely. Brady, man, it's on you, man. Wrap us up. Season 1, episode 9.
Yeah, buddy. So to all y'all out there, we want to say sayonara, adios, and we'll holla.
Peace.